property markets are changing in front of our eyes, aren't they? But today I want to share with you a couple of things that are changing that you may not be as aware of. One is the ghost towers that are occurring in Sydney. What's a ghost tower? Find out. It may not be what you expect. Interestingly, I've seen the phenomenon elsewhere in the world, and I'm going to explain what's going on back home. We're also going to have a chat with Andrew Mirams about the changing finance market and bust some myths, some things that you may not yet know about what's happening in the world of finance. And we're going to have a chat in my mindset moment about 12 things that are more important than money. We know that money is important in areas where it's important and not at all important in other parts of your life. So let's put some perspective to this so that at the end of this show, you're going to be a more informed investor, business person or entrepreneur. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
Ghost towers are springing up across Sydney. Now, just to make things clear, I'm not talking about haunted buildings, even though I do remember some fun nights when we did the Sydney ghost tour around the Rocks Centre. That was fun. But anyway, what I'm talking about are empty apartments as developers release even more high-rise apartments into a saturated Sydney unit market. It seems that 26,000 new apartments are going to hit the Sydney property market this year, adding to the 28,000 apartments built in 2018. In other words, by the end of this year, around 54,000 new apartments will have flooded the Sydney property market in just 2 years. And this has obviously led to an oversupply of apartments for sale and for rent. Of course, this has occurred at a time when first-home buyer incentives have worked, with 1 in 4 people in the Sydney property market currently buying their first home. It just hasn't been enough, though, to soak up this extra supply of apartments, and ghost towers are on the rise in Sydney. Now, I've read about this happening before in Singapore, in Vancouver, and I actually saw it in China, where there were whole estates of big empty buildings. But recently, the Sydney suburb of Carlingford, about 22 kilometres northwest of the CBD, has hit the limelight, where there's a large number of high-rise apartment blocks that were approved way back during the property boom. But now they're coming online. And from all reports, they're just not selling or leasing, and these ghost towers are prevalent in other suburbs as well, where there have been multiple developments of high-rise towers. Overall, Sydney's vacancy rate's sitting at about 3.4%. Now, interestingly, that's the highest since records were started being kept in 2005. And some are suggesting that the vacancy rate could get up as high as 4% overall in the Sydney market. But in some suburbs, like Carlingford, where there's been an overdevelopment, the vacancy rate's almost double that. In Carlingford, it's around 6.3% at the moment. In the Hills district in the northwest of Sydney, vacancy rates are sitting closer to 6%, and in some locations even as high as 7%. In the Sydney CBD, in the middle of town where there's all those apartments, the vacancy rate's 5.4%. And that's not conducive to rising rents or rising property values. In fact, it's created a tenants market because currently tenants are spoiled for choice and they've got an upper hand in rental negotiations. Now, obviously, that's a bit different to how it was a couple of years ago when vacancy rates were closer to 1.7%. This means most Sydney landlords, property investors, need to keep their rents the same when the lease expires, or many have to actually drop the rents when their property becomes vacant to find a new tenant. Now, I'm pleased to say that the Sydney vacancy rates at Metropole Property Management are about half the general market, the industry averages, and they're currently sitting at well below 2%. When speaking to Leanne Jobs now, the National Director of Property Management, she explained this is in part due to proactive property management, and I'm proud of what our team are doing, but a large factor is the type of properties that we've bought for our clients over the years. We've bought established apartments in small blocks, the sort that we used to be called flats, those that are close to amenity, those that are still in strong demand, those that have got a bit of uniqueness to them. And those sorts of apartments are holding their values well, and they're leasing more quickly too. I'll explain a bit more about that in a moment. But the problem is we're building too many of the wrong type of apartments. There are too many of the wrong type of apartments for sale and lease. When it comes to apartments for sale, there's about 14,000 apartments available, double the number for sale back in 2017. And currently, the apartment market's being artificially propped up by developers manufacturing scarcity by holding on to their stock. They're not releasing a lot of their vacant apartments on the market because the markets are saturated. It makes more economic sense for them to hold on to them, not to try and sell them, not to try and lease them. When they can't, they don't want to pull the markets down further. At the same time, many investors, particularly foreign investors, they're not putting their properties on the market for lease. They're keeping them in brand new condition. They're waiting for better times. Foreigners often see that just as a store of value of their money, and they don't want to rent their apartments. Now, you've probably read that governments are attempting to address this situation. Back in December 2017, the federal government introduced a foreign owners vacancy tax. This is where they charge owners a fee if their properties were unoccupied or rented out for less than 6 months in a year. This has been hard to police, and it only applies to properties bought after 9th of May 2017. But anyway, as I was starting to say, we're building the wrong sort of stock, buoyed by these hordes of foreign investors and a new generation of local investors who really didn't understand what makes a good investment. Developers built high-rise apartments aimed at these investors in suburbs that were traditionally dominated by single-level houses, such as the Hills District in Sydney, the Penrith region, the Upper North Shore. The new apartment buildings in the Hills District, many released just before the opening of the Sydney Metro Northwest Rail Link, they were clearly out of sync with what local tastes were in the region, which traditionally drew families seeking space, seeking backyards and front yards. There just isn't the same underlying demand for apartments in many of these suburbs as there is in the inner suburbs of Sydney. And this has led to high vacancy rates. Currently it's 5.6% in the Hills District and closer to 8% in Rouse Hills, Kellyville. They're just not finding the tenants. And of course, investors are going to lose out, not just because they're not getting the rent, but because they're unlikely to see an increase in the value of their properties for at least a decade. And those who wish to sell, and unfortunately some are going to have to sell, they're going to find it really, really hard to find a buyer, aren't they? There's too much stock for sale anyway. And some of them are still new stock coming from developers. So how are you going to sell up if you have to? Now, of course, there's nothing new about this. Off-the-plan apartments have always made terrible investments. You've probably heard me quote the BIS Oxford Economics report from earlier this year before, that of the apartments sold off the plan over the last 8 years, 2 out of 3 Melbourne apartments made no price gains or lost money upon resale. That's 2 out of 3 apartments bought in the last 8 years didn't make money. And this is despite record immigration and a significant property boom over that period in Melbourne. In Brisbane, about half the apartments bought off the plan are selling at a loss or no profit. And in Sydney, about 1 in 4 apartments bought since 2015 are selling at a loss or no profit. In other words, most investors who bought off the plan in these high-rise apartment buildings have lost money, or they haven't made any money, or they've missed a great opportunity. And of course, there's all those sitting on the apartments which are continuing to fall in value, and they haven't crystallised their loss yet. So according to this research by BIS, resale of apartments within 3 to 5 kilometres of the CBDs of Sydney, Melbourne and Brisbane realised consistently lower prices than established apartment resales. Let me say this another way. Established apartments, the sort that I was talking about before, the sort that used to be called flats in the past, the older, better built, nicer layout, in smaller blocks, in good locations, those buildings outperformed new apartments. When I was young, we used to call them flats. They were built solidly and while they may not be as pretty as the glitzy new apartments that were built with investors in mind, they are what we call investment-grade properties because they appeal to a wider range of more affluent owner-occupiers, not just investors. They're in the right locations. By this I don't mean just the right suburbs, but locations within the suburbs, the right ones too, because they're not right on the main roads where a lot of the new apartments are being built. They're usually a couple of 100 metres away from the main roads, a short walking distance to lifestyle amenities, cafes, shops, restaurants. These apartments have got street appeal, they've often got good views, they offer security, and they've usually got the ability to add value. That's one of the things I love about buying established apartments, and they have a high land to asset ratio, which is very different to the big buildings where there's 100 or 200 apartments on the block. The bottom line is buying the right investment grade property is all about following a proven blueprint that successful investors follow. And over the weeks, I share this with you in these podcasts. I know I'm going on about it, but it surprises me that people are still emailing me, leaving comments on my podcast, leaving comments on my Property Update blog, talking about buying off-the-plan apartments. And that's why I'm going to length to explain, avoid them. You're more likely to increase your chance of financial success in the future and reduce your risk of getting caught out as the property market moves on to the next cycle by buying the right property. You've got to get it in the right location, buy the right property. Don't worry too much about the timing because the downside is minimal now and the upside is more positive. This is one of the best counter-cyclical opportunities I've seen for many decades. And if you're not sure what to do next, with so much advice out there, if you're confused by all this advice and you want somebody who's not going to sell you a property but give you strategic advice, why not have a chat with the team at Metropole? Our property strategist will put a strategic plan to you explaining what's possible, what you can achieve, how many properties you need to get to achieve the goals you want. Remember, we've got no properties for sale. We never have. And because we have our on-the-ground own teams in Sydney, Melbourne and Brisbane, plus a wealth advisory arm, we've got a depth of information and experience that'll help you through these changing markets. Why not go to metropole.com.au, leave your details, and I'd love my team to be involved in your journey. Whether you're a beginner or a seasoned pro, we'd love to help you. We'll either formulate an investment strategy for you, review your portfolio, or help you take your investments to the next level. metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I write a lot about money and property in my blogs. I discuss it in my podcasts. But when you get to know me, you'll realise that I believe true wealth is what you're left with when they take away all your money. Sure, money's important in some aspects of your life, but it's not important in others, is it? So in today's mindset moment, I'd like to share with you a list of things that you'll regret in the future if you don't do them now. It's a way of me emphasising the point that money is important in those areas where it's important and not at all important in other areas of your life. So number one, put your health and wellness above everything else. There's an old saying, if you don't have your health, you have nothing. I think that's true. Number two, take the time to do the things that you love. Now this may sound cliche, but work less and play more. You'll never regret taking a vacation, engaging in a new hobby, or spending a day with those who make you happy. The third thing I'd like to remind you is to stop taking life so seriously. Why are you taking it so seriously anyway? When you think about it, most of the things you worried about in the past never really occurred, did they? The fourth thing I'd like to share with you is always say what you need to say. If you love somebody, tell them. If somebody hurt you, tell them. If you've got trouble expressing your feelings, write a letter, do an email. Make sure that those around you know each and every day how you feel. The fifth lesson is open up your mind to possibilities. If you have a closed mind, if you stay in your comfort zone, you'll never get to the next level. You'll never truly enjoy life. The sixth lesson I'd like to share is follow your own path, live a true life, one that's true to you. Stop comparing yourself to other people and stop trying to be a perfectionist. Stop living a life based on the expectation of others, or what do you think others are achieving? Because when you look at Facebook and you look at Instagram, you're seeing their highlight reel. You're not seeing all the bits on the cutting room floor. Another lesson to know is stop living in the past. Right now, you need to throw away the regrets from the past. It's gone. There's no point dwelling on what could have been. Doing so is only going to rob you of the joy of what's happening at the moment. The past doesn't exist other than a memory. It's a mental story, and it can't be changed, so move on. I guess that brings me to the next lesson. Accept the things you can't change. Lesson 9 I'd like to share with you to show you that there are 12 things at least that are more important than money is practice mindful living. Mindful living will slow down time. It will enhance the present moment. It'll fill what could have otherwise been mundane days with awe and with joy. Appreciate what you've got. Be grateful for what you've got. The 10th lesson is stop chasing money, fame and possession. I know we crave wealth, prestige, fame and popularity. We crave material things, beautiful people, the next big toy, the shiny object. We mistakenly think that happiness is going to arrive when we meet these goals. Instead of enjoying our life, we seem to be in constant pursuit of something other than what we've already got, what we've got right now. At the end of your life, your expensive BMW, that's not what's going to be flashing through your mind. You're more likely going to be remembering about the memory of a loyal dog or a loved one. So stop chasing material possessions. There's no real happiness there, only an endless pursuit. And another lesson I'd like to mention to you is always practice gratitude. I've already said it briefly before, but you'll never ever be wealthy if you're not grateful for what we've got. And you live in the best country in the world, the best time in history. Enjoy it, appreciate it. And the last thing that's more important than money is love. Pay attention to all the sources of love in your life, and you'll develop a growing sense of abundance of how much beauty surrounds you each day. So, remember, there are many things in this life more important than money. I've often said that residential real estate investing is a game of finance with some properties thrown in the middle. So to get a better understanding of how to get the banks to say yes in this more challenging finance environment, I'm having a chat with award-winning finance broker and Director of Intuitive Finance, Andrew Mirams. Welcome, Andrew.
Hi, Michael. How are you?
Good, thank you. And Andrew, I'd like to today have a chat about some of the myths that people come to you as a finance strategist with to help clarify maybe the reality of what's going on in the world of finance. What are some of the common misconceptions people come to you with?
Yeah, it's a really good question. I think one of the first things is Australians are very loyal. And we seem to think that just because we've banked with someone for a long time, that gives us some sort of right or entitlement. Unfortunately, the law doesn't dictate that. So the old, "oh, my bank will look after me" is a statement I hear all the time because of probably their misguided loyalty. That's not true. You know, your bank has a responsibility via the laws to assess you on the current day practice. It doesn't matter whether you've banked with them for 1 year, 10 years or 100 years, it's actually irrelevant. It's what your obligation is to meet the current assessment criteria of the day. So my bank will look after me is something we hear quite often, but it's not actually a relative one.
So Andrew, how does that negatively impact a potential borrower?
Yeah, and that's probably where it rolls into the second point is, people think, I got money before, I'll get it again. We have cycles in Australia, and we have cycles everywhere, and you and I know that. We've spoken many times about that. And just as the property and the share markets and everything like that moves, we also have credit cycles. And that will mean at different times the handbrake will get pulled on, and we'll have a tightening cycle, and we'll also have then an easing cycle. It's not turned on and off like a tap. It's a lot harder to control. But we've been in the last 3 to 5 years through our regulators been in a tightening cycle where we've been seeing many, many things change, and there's a lot more scrutiny. So the fact that you got it in the past and you didn't have to do some of the things you have to do today will have little or no relevance on what you have to do today. That's just the reality of the world we live in today.
And that came about because there were some, let's call them loose lending practices, and the banks are really wanting to make sure that you can repay the loans. But they did go a bit overboard. APRA's macroprudential controls ended up creating a credit squeeze that now the screws are being loosened a little bit. But it still seems, despite that, they're looking more carefully at your expenditures, at your credit card debts, and other things. I didn't have to do that before, Andrew.
No, in times past, a credit card debt, people, if you could prove over 3 months that you'd paid and cleared the full balance, then they didn't account for the limits. But the reality is at any given stage, people's circumstances could change. And that limit means that you could, whether you're using it or not, you could spend up to it. So the impact of credit card limits, and now you've got the buy now, pay later, and the zip pay and all those sort of things. That's become incredibly popular. It's, I guess, for us older heads, Michael, we used to have lay-by where you'd go in and you'd pay it off and you'd only get the goods and services once you've fully paid for it. Now we
afterwards,
live in
not before.
Correct. And now we're in a society of everything's now. We're in an immediate society where we get it today and we'll pay it off after. So those sort of things are having quite a significant impact. And people often don't think what impact they can have, the buy now, because it actually is a commitment. It might only be for a month or 2 or 3, but it is a commitment. And similarly, as is a credit card, whether you use it or not, you must disclose it. And from the 1st of July in 2019, we're going to have open banking, and all our lenders are going to have far more access to people's credit, how they're operating it and things like that. So if you're not disclosing it, you're going to be caught out.
So how does that impact me? Do I really have to tell them everything I spend? Do I have to disclose those things today?
Look, you do. We've always had expenditure. And again, we've spoken about this. You earn your income, you have a life to live, and then you've got left over what it is to invest or spend or in discretionary items. Now, we didn't have to analyse this in times past, but there's been some significant work around just making sure people don't overcommit themselves, so they don't invest first and then try and live afterwards. Because even though Australians have proven incredibly hardy, and there's stories that they'll eat dog food before they'll lose their house. But the fact is, you don't want to ever put anyone into that situation. So there's a lot more analysis on spending. We've had instances where someone took $200 out at Crown Casino and they were asked, do they have a gambling problem? Now, Crown's an entertainment complex. You can go there for dinner, you can go to the movies, you can do all sorts of things. And similarly with people, if they go to, and buy someone a gift at Dan Murphy's, do they have a drinking problem? The scrutiny now is quite incredible, but you need to be able to break it down and give us an idea of what it is you spend. The days past we just say, I spend $4,000 a month or $5,000 a month and not analysing it or not doing any work on it. Those days are gone. You need to have some idea of what you spend. And the one thing that I think that we always need to talk about, and we talk with all our clients about, is the discretion. The old fallacy of, I earn more, so I have to spend more. That's just that. It's a fallacy. You spend it because you can, not because you have to.
So that's a trap people have. And the other one is assuming that their credit card limit is actually their money. It's not. So you can't go and borrow it and think it's yours. You've actually got to pay for a right for it, and you often pay at quite a high interest rate. But I hear a lot of clients say, look, I can service my debt. I've got a whole lot of equity. I've got cash flow left over. Why can't I afford it? So what's really the difference between affordability and how the banks see serviceability?
Yeah, great question, because that's probably the one, after all the other things we've spoken about, that's the one we tend to spend most of our time talking to our clients about. So if you're meeting all your commitments, and let's say you've got X amount of commitments and you're just paying interest only, you probably are meeting them quite easily. When record low interest rates, if you're only servicing that interest, the rent's probably paying a fair part of it, and you're getting, and so the outgoings are probably fairly minimal. However, that will be at a rate of somewhere between 4 and 5%, let's say, for an investment loan. The reality is that banks are still servicing those debts at around 7.25%. Then they look at the remaining balance. So if you've had a 10-year interest only, they'll service your loan or amortize it over the remaining 20 years. And then if you add in a higher interest rate and a much lower term, that has significant impacts on your borrowing capacity. And that's where the servicing piece, and I think APRA and the regulators have done a really good job. I don't think they've articulated some of the things that they wanted to get out of this very well. If we went on an education and advised people this is what we're looking for and this is what we want to guard you from, then I think we would have had a better and an easier ride through the last 2 or 3 years.
Well, clearly they stopped the bubble that would have occurred 3-4 years ago when 50% of all properties purchased in Sydney were by investors. That was unsustainable when property values grew at double-digit rates of growth and people's wages were hardly going up. Again, all that was unsustainable. They probably took a little long to loosen the screws, but that always happens. It's the cycle of finance, as you said, the cycle of property. But it seems like the cycle's turning. So do the banks want to lend money? Are they really interested in giving me something, Andrew?
Yeah, the cycle, I think we've sort of hit the bottom of our credit squeeze. I believe that the regulators have now said, okay, we don't want markets in decline. We want a nice balanced market. And we said this all along. Like you said, when we're getting capital growth at 15 to 20% year on year, that's unsustainable. But similarly now, we don't want the same in reverse where we're losing 10 or 15% a year. So they want a balanced market. So the regulators have now started to talk about looking at these headline rates I just talked about, the 7.25, and saying when we don't think that's probably the right guide rate. We're going to give the banks a little bit of leeway in saying, look, here's the actual rate plus 2.5%. So if we were to say a home loan rate was 4%, 2.5% on top of that, 6.5%. That's going to have a significant impact for home borrowers and people that wanting to get into their homes in terms of being able to. They're still going to have to assess their credit cards. They're still going to look at their spending and everything like that, but it's going to make it slightly easier for them to be able to get access to the credit to buy the home that they're hoping to, not just what they can afford. So I think that'll have a positive effect for our homeowners in the short term. What the regulators have done has been very reactive. So I think what they're doing is reacting now to some negative markets. So I think if the markets don't start to correct and people get a bit more confidence with the markets and things like that, then we might see some more things where we just see slight easings. It won't ever go back to what it was, but I do suspect we'll see some easing in terms of some of the things that we've had to look at or analyse in the past.
Well, that was the past, and that's the way it used to be. So this is a new environment, and to navigate through the environment, I have always felt it's good to have a finance strategist on your side and not go to the banks, because the first message you said was the banks really aren't on your side. And often the people you're speaking to there are salespeople. It's their job to sell the bank's products and to sell ancillary products. And having a finance broker, which is actually different. Anyone can get you a mortgage loan, but having somebody who thinks strategically on your side makes a big difference. So I'm very pleased that the recommendations of the Haynes Royal Commission are now not going to be followed through, and people like you are still going to be around to help me and our clients.
Yes, I'm very glad about that too, to be honest, Michael. Yes, it was a concern there for a while that some of the recommendations weren't actually going to promote competition and be good for our clients. So I think with everything that's happened, the Liberals getting back in, the coalition getting back into power, they've been very supportive of our industry and the work we do. Around about 60% of all mortgages are originated by mortgage brokers. So I think people are voting with their feet and looking for that choice. So I think all round it's been a good outcome.
As people in your position level the playing field, it's just too hard, it's just too confusing to understand the many products and what actually works right for you. And there are a lot of people, such as yourself, who do a great job helping protect clients. So thank you for explaining some of the myths and some of the ways one can work around those, Andrew. Look forward to having a chat again real soon.
My pleasure, Michael. Thank you.
Well, that's almost the end of today's show, but I'm going to read out some reviews, and if one of them's yours and you email me, I'll post you a gift of one of my books. Email me at michael@metropole.com.au. But before I do, if you've got benefit from the show, why not tell somebody about it? I am trying to inform you of the changes that are happening in the market, so why don't you pass the message forward to somebody? In every podcast app, there's a share button down the bottom. I'd love you to pass it on to somebody or tell somebody about it or pass it on through social media. That would do me a great favour so we can together spread the message and help as many people as possible. And clearly people are getting benefit from this because there was a recent review left by Brendan from New Zealand saying, "Hi Michael, while some of the rules are different in New Zealand, I really appreciate the similarities with regard to the strategies of buying and holding quality properties in better locations. Your advice is sound and your podcast's excellent, with an interesting mix of information from mindset to investment strategy. It stands out amongst the other property podcasts." Thank you so much, Brendan. And Daniel J88 said, "I've been listening to Michael's podcast for a year now, and I've been dissecting each and every episode from the wealth of knowledge that's there. When it seems like everyone in property space is selling a get-rich-quick scheme, it's refreshing to know that long-term gains attributable to following Michael's proven strategies." Well, thank you very much, Daniel. Thank you very much, Brendan. I look forward to being an ongoing part of your wealth creation journey as I share this podcast with you twice a week, as with everyone else who's listening right now. Look forward to catching up with you again real soon.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?